Mr. Prime Minister, Hürmetli Hanımlar, Mırzalar, Khayırlı Tan. Ladies and gentlemen, good morning. It is an honor to be here at the Astana Mining and Metallurgy Congress again to discuss the key global trends in the industry. PwC has very recently just published the annual review of the global trends in the mining industry called MINE, and today I'm going to share with you the key highlights of the findings that we have. First of all, we look at the analysis of the 40 largest mining companies by market capitalization in the world, which are important and shape the future of the industry. I'm going to cover briefly the industry in perspective, a view from the top, in other words, what the CEOs actually are thinking, financial highlights briefly, and the strategies that are adopted by the companies to fight against the downturn. And I'll make a few remarks at the end about the outlook. Industry in perspective. Looking at the industry, 2013 was another challenging year for the industry, with double-digit reductions, not uncommon across commodity prices. Gold producers were the hardest hit, with gold prices suffering their greatest annual decline, roughly 27%, in over 30 years. A number of factors have forced the mining industry to react to the changing times. Commodity prices are down. The new CEOs, which is in nearly 50% of the top 40 companies over the last 2 years, a lot of pressure from the shareholders to improve returns, cost reduction initiatives taking time to implement, and there is focus on delivering disciplined capital allocation. Now, looking around, license to operate becoming increasingly difficult, particularly in emerging economies. And finally, there are now more emerging markets companies in the top 40. Now, despite all this volatility, the industry is supported by over a long-term demand fundamentals, specifically from emerging markets, particularly China. Now, given the significance of China market for Kazakhstan, I'd like to pick up a couple of points that I think are important. First of all, the copper boom in recent years has been inextricably linked to the growth of China, which consumes about 45% of the total supply. However, apart from traditional consumption from construction and other industries, copper has also been stored in bulk and used as collateral for lenders. It's been reported that financiers in China commonly accept copper contracts and inventories as a basis for extending credit, with up to 60 to 80% of copper imports having been used as long collateral. With China tightening liquidity, month-over-month volatility in imports seen in early 2014 could signal that cash for copper in deriving the price more than long-term demand fundamentals. In March 2014, China's first onshore default partly contributed to the biggest decline in copper futures in New York in more than 2 years. As a result, copper prices have lost just over 9% in only 4 months as of April 2014, with also RMB currency fluctuations another contributing factor in price volatility. Now, the lack of transparency inherent in Chinese copper trading and potential for more defaults could significantly increase the volatility in copper prices. Looking at the view from the top, these are clearly difficult times in mining, with few commodities and jurisdictions immune from the challenges recent years. That said, it appears most have weathered the storm, and we are hearing mixed views, caution and optimism from CEOs of the top 40. The leaders of the top 40 companies are experiencing the same challenging market conditions. The newly arrived CEOs have heard the message in no uncertain terms. A clear mandate exists to extract full value from your assets. Responding to the most recent downturn in commodity prices, the CEOs are managing stakeholder expectations. This is done through cutting operating costs. They're being more selective on capital allocation decisions. They prioritize development of low-cost Tier 1 assets and streamline and simplify operations by selling non-strategic, non-core interests. Looking ahead, a new attitude is developing. Many of the CEOs are looking at the next phase of growth as the lowest cost producer among their peers. The next phase is going to be about regaining investor confidence by growing profits and ultimately shareholder value, proving the cost reductions and efficiency gains are sustainable. The CEOs acknowledge that high-cost mines will be challenged to improve profitability or risk extinction. Total asset base of the top 40, looking at the financial highlights, has increased by 7% despite the record levels of impairment recorded this year. The top 40 spent $130 billion on capital expenditure compared to about $127 billion last year. Balance sheets are geared for the future. The gearing ratio at December 13 was about 39%, substantially higher than 27% last year. And top 40 took advantage of the relatively cheap cost of debts compared to raising equity. They continued investment in fixed assets. They took record impairments, again, booking record impairments this year, about $57 billion. And this drew aggregate net profits of the top 40 to their deepest depths in a decade at $20 billion. And finally, market capitalization of the top 40 fell by $280 billion, or 23%. Following years of investing in projects, top 40 grew production across most commodities during 2013. While prices softened over the year, it's not clear if the increase is a result of more traditional strategy of reducing unit cost through economies of scale, or miners delivering productivity improvements through debottlenecking existing operations. Iron ore production was maintained on the back of stable prices, and the improved price was contrary to market expectations, which anticipate higher volatility in price. So we noted production growth continued despite price falls. In terms of gold reserves, falling prices brings increased conservatism, and there is increasing role for emerging markets. So what are the company's CEOs looking at in terms of their strategies to beat the downturn? More recently, in the face of falling and volatility in commodity prices, many miners have reacted by reducing headcount, closing unprofitable operations, and deferring capital expenditure or reduce cash costs. The productivity imperative is absolutely clear. Headcount reductions and expenditure curtailment might be effective in reducing controllable cash costs in the near term, but long-term sustainable gains depend on strong underlying improvements in the efficiency of operations and invested capital. There are three key levers available to miners to improve productivity, and in turn, obviously, to shareholders' returns. The first lever is looking at the mine operating strategy. To maximize shareholders' returns, mines will typically adopt one of two strategies. One is portfolio management, and second is innovation. With changes in CEOs and continued margin pressures, it is not surprising mining companies are focusing on portfolio management decisions to deliver shareholder value, flexing where and what to mine, which assets to put on hold, and whether to close or divest. Almost a quarter of the top 40 are diversifying geographically, expanding beyond domestic borders. Maybe there is room for Brazil, Kazakhstan to come together. The majority are represented by miners based in Russia, India, and China, who predominantly operate domestically, but are now looking to expand beyond their own borders. The second one is almost a quarter of the top 40 has divested what they consider to be non-core assets and are looking to do so in 2014. And finally, sharing risk and capital, it appears that companies are exploring potential joint ventures as a way to improve profit margins at existing operations by leveraging efficiencies of regional proximity. Innovation can help the industry enhance profitability and productivity, address labor shortages and costs, and develop technologies required in more difficult conditions, such as declining grades, remote locations, and deep mining. Compared to other industries, mining is very conservative in terms of research and development investment. However, this does not mean that innovation is not important for the mining industry. In the years to come, it's going to get harder and more expensive to mine, and companies need to innovate and do things differently. Despite recent cost pressures, we see big companies still investing in the future. While the top 40 assess and disclose risk of operating in emerging markets, resource nationalism is here to stay. There is an increasing trend of governments looking to maximize returns from their national resources and impose windfall taxes and other measures to more effectively manage the monetization of their natural resources. Fulfilling global transparency expectations to local stakeholders are important. The total positive impact and value of mining companies extends well beyond tax paid. It is clear to us that companies should take a holistic view of the social, environmental, economic, and tax dimensions of their activities and need to quantify and articulate the impacts of their activities and contributions in places where they operate. Looking ahead in terms of transactions and mergers and acquisitions, with steep declines in the market capitalization of mining stocks, mergers and acquisition activity continued to be subdued during 2013. However, we see hostile takeover activities emerging. Divestments were a hot topic, with focus on simplifying or improving portfolios, and we expect divestment activity is expected to continue in 2014. Joint ventures and partnering as a means of driving efficiency is clear, and public market offerings were the lowest in 5 years. Attention turned to private equity as an alternative source of capital. While bargains may appear to exist, with company valuations at relatively low levels, miners are busy doing homework on the buy versus build equation. With recent impairments, no one wants to overpay in uncertain times. In summary, the consequences of the mining's confidence crisis continued throughout the year, one of the toughest years in memory of mining, and it seems no one was immune. Commodity prices dipped again. Gold producers were the hardest hit, with gold price suffering their greatest decline. Many commodities encountered short-term demand volatility, coupled with calls for restraint over projected growth rates over the next 3 to 5 years, although China's expected growth remains strong in absolute and relative terms. Looking at the outlook, long-term demand fundamentals from emerging markets continue to provide hope, China leading the way with an envious growth rate of 7% by 2018. Resource nationalism is here to stay. Difficulties with license to operate will continue. Revised strategies have been put into motion. Market is now looking for results. We expect to see some moves towards consolidation, friendly or otherwise, if only to seek out synergies to reduce costs in this low-price environment, consistent with the new mantra of lower cost, higher productivity. Rahmet.